Hello, everyone. I am Kato, CFO. I will now talk about our financial strategy and risk management. As explained today, we are accelerating our transformation into a digital-centric company. We aim to evolve Lumada through generative AI to achieve high profitability and sustainable growth. Of course, we have confidence based on what we have built up over the years. In recent years, geopolitical risks have increased, and global trade conflicts and regional disputes have become more apparent. Furthermore, with the rapid advancement of generative AI, we recognize that major changes are occurring in global politics, the economy, and society. In this time's management plan, even in the face of this uncertain business environment, we have referred to benchmark practices and decided to present our 3-year targets not as absolute monetary values, but as ratios and ranges to better illustrate our vision. Today, I hope to help you understand this approach thoroughly. Now, I will explain the 4 key points: enhancing cash generation capabilities, balanced capital allocation, improving capital efficiency, and reinforcing risk management. First is enhancing our cash generation capability. Under the new management plan, Inspire 2027, we aim to expand revenue and improve margins by expanding our core Lumada business. In addition, we will enhance cash efficiency by improving the conversion from profit to cash and continuously expand core free cash flow. As explained today by each sector leader, we are promoting growth strategies centered on the Lumada business to achieve the targets shown on the left. Hitachi's overall EPS has grown at an annual rate of 15% so far, and we aim to continue improving it. Furthermore, by improving CCC and other metrics, we aim to raise our cash flow conversion rate to over 90%. Core free cash flow has grown at an annual rate of 23% so far, and we will continue to grow it steadily. Second is balanced capital allocation. Our basic policy, as with the previous 2024 midterm management plan, is to prioritize returns and flexibly allocate cash in a balanced manner, and to growth investments and shareholder returns. First, investment in inorganic growth shown at the center. In our new management plan aiming for sustainable growth, we are considering increasing the total amount of inorganic growth investment compared to the 24 MTMP. Naturally, these investments will be focused on areas aligned with Hitachi's overall growth strategy, aiming for high profitability and capital efficiency. Specifically, as explained today by the sector leaders, the investments will mainly target digital enhancement and service expansion, and most will likely be bought-on M&A to strengthen existing businesses. In addition to strategic alignment, there are quantitative hurdle rates. Specifically, we use the margin and capital efficiency targets set out in the new management plan as benchmarks. On the financing side, we intend to utilize borrowing leverage in accordance with the financial discipline stated here. Next is shareholder returns. Our basic policy is to expand the amount of returns over the medium to long term. Specifically, we aim to return more than half of our core free cash flow and net income to shareholders. As for dividends, we will continue to pursue stable dividend growth in line with business expansion as we have done in the past. On the other hand, we will carry out share buybacks flexibly, taking into account cash generation, financial condition, and asset sales. To summarize, the diagram on the right shows our cash allocation approach. First, core free cash flow will be allocated to growth investments and shareholder returns, as explained earlier. Next, asset sales will be used for growth investment opportunities that meet the criteria of strategic fit and hurdle rate. If such opportunities are not available, the funds will be used for shareholder returns, specifically for share buybacks. Leverage will be used for growth investments. Loan repayments will be considered as the last priority, except in short-term cases such as when we receive large advance payments. Here, I would like to review the past trends in shareholder returns. As shown on the bottom left, based on our record of continuously expanding core free cash flow, we have maintained an increasing trend in annual dividends over the past 14 years. From fiscal 2010 as the baseline, we have achieved an annual growth rate of 16%. We also plan to increase dividends this fiscal year compared to the previous year. The upper right shows the trend of share buybacks. Taking into account our cash generation capacity, our financial condition, and asset sales, we plan to increase share buybacks by 100 billion yen from last year, totaling about 300 billion yen this fiscal year. As a result, our total payout ratio has shown an upward trend, achieving 54% in the 24 MTMP. We expect to maintain a payout ratio of over 50% this fiscal year as well. The third point is improving capital efficiency. By expanding the Lumada business, we will increase returns and optimize invested capital to improve ROIC. We believe that inorganic growth investments are necessary for sustainable growth. Even if ROIC temporarily declines after investment, we will work toward an early recovery by not only improving ROIC, but also lowering WACC to widen the ROIC spread. Return growth on the numerator side will be driven mainly by enhancing the growth and profitability of the 4 core sectors centered around Lumada business. On the denominator side, we will optimize invested capital through asset-light strategies and capital structure optimization. Asset sales will be considered based on criteria such as Lumada's growth potential, the rationale of ownership, as well as ROIC. In addition, we aim to widen the ROIC spread by reducing WACC, including the use of leverage. Number 4, I will talk about reinforcing risk management. In response to the increasing uncertainty in the business environment mentioned earlier, we are promoting enterprise risk management, ERM, through collaboration among sectors, regions, and corporate functions in order to centrally identify and address major risks across the entire Hitachi Group. Please let me explain the risk of reciprocal tariffs with the United States, which is a highly important short-term issue. At this point, there have been no significant changes from what was explained in our earnings announcement at the end of April. However, we are continuously reviewing the situation as it evolves, and we plan to provide an update during the Q1 earnings announcement at the end of July. As part of our risk management framework, in addition to existing structures, we have appointed RMOs, risk management officers, to each sector, region, and corporate function, and we operate ERM under the One Hitachi structure. In this framework, I serve as the Chief Risk Management Officer and oversee risk management activities across the all of Hitachi under the CEO. In our ERM, major risks are visualized and organized company-wide using a risk heat map. This image here shows examples of major risks, including trade disputes such as reciprocal tariffs with the US, talent acquisition and retention needed for business expansion and transformation, as well as technological advancements such as AI. We are working to minimize these risks by leveraging Hitachi's diverse business and regional domain knowledge. In addition to minimizing the risk of damage, we are also committed to minimizing the risk of missing growth opportunities. Lastly, summary. First, we will improve revenue, operating profit margin, and cash flow conversion to continuously strengthen our cash flow generation capacity. The cash generated will be allocated flexibly and in a balanced manner to growth, investments, and shareholder returns. Next, we will expand returns and optimize invested capital, increasing capital efficiency over the medium to long term, even while making inorganic investments. By transforming Hitachi into a digital-centric company with the Lumada business at its core, we will enhance our corporate value even amid increasing uncertainty in the business environment. Moving forward, we will continue to engage in two-way dialogue with our investors and strive to further enhance corporate value. So we appreciate your understanding and support. That concludes the CFO session. Thank you for your attention.